This episode is brought to you by Merrill. Join one of the most iconic names in wealth management, Merrill. You'll be part of a dynamic team of advisors and specialists working hard every day to grow their clients' wealth. And with the support of best-in-class research, advanced digital tools, and the resources of a global institution, it's truly an opportunity you can be bullish about. Learn more at careers.bankofamerica.com. Copyright 2024, Bank of America Corporation.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See detail.
Welcome to Learn Finance 101, where we break down essential financial insights to help you make informed decisions. Alright, let's start from the top. So what exactly are Treasury bonds, or T-bonds for short? Treasury bonds are a type of government debt issued by the US Department of Treasury. When you buy a T-bond, you are essentially lending money to the federal government, and in return, they promise to pay you back the full amount on a set date known as the maturity date. Along the way, they'll also pay you interest, usually every 6 months, making it a form of fixed income security. It's the government's way of borrowing money to fund everything from infrastructure projects to military spending. And because the US government is considered one of the most creditworthy entities in the world, Treasury bonds are seen as one of the safest places to park your money. Treasury bonds have a long history and they are deeply woven into the financial fabric of the United States. They go all the way back to the founding of the country. Alexander Hamilton, the first Secretary of the Treasury, helped create the bond system to manage the war debt after the Revolutionary War. Since then, they've played crucial roles in funding everything from the Civil War to World War II. And even modern-day economic relief efforts, like during the financial crisis of 2008 and the COVID-19 pandemic. They've evolved over time, but the fundamental idea remains the same. You give the government your money today, and they promise to pay you back later, with interest. Now, Treasury bonds are just one of several types of Treasury securities. The US Treasury actually issues 3 main types. First of all, Treasury bills. They are short-term securities that mature in 1 year or less. They don't pay interest like bonds, but are sold at a discount to their face value, and you make money when they mature at full value. Then Treasury notes, or T-notes. These are medium-term securities, typically maturing between 2 and 10 years, and they pay interest every 6 months, like bonds. And Treasury bonds, T-bonds, the focus of today's episode. These are long-term securities, with maturities ranging from 10 to 30 years. They are great for investors looking for long-term, stable returns with the backing of the US government. There are also Treasury inflation-protected securities, or TIPS, but we'll save that for another episode. Here is how it works. When you buy a T-bond, you're lending money to the US government, and in exchange you'll receive 2 key benefits. Interest payments. The government will pay you a fixed interest rate, called a coupon, every 6 months until the bond matures. And principal repayment. At the bond's maturity date, you'll get back the bond's face value, the original amount you invested. For example, let's say you buy a 30-year Treasury bond for $1,000 with an interest rate of 3%. Every 6 months, you'll receive a $15 interest payment. After 30 years, you'll get your $1,000 back. Easy, right? It's this reliable income stream and government backing that makes Treasury bonds so attractive to risk-averse investors. Now, you might be wondering, why would someone invest in treasury bonds when the stock market often offers higher returns? Well, treasury bonds aren't designed to compete with the stock market's returns. They're designed for stability. Here are a few reasons why investors choose T-bonds. First of all, safety. US Treasury bonds are considered some of the safest investments in the world because they are backed by the full faith and credit of the US government. Then regular income. Bonds provide a steady, predictable income stream through interest payments. This can be especially valuable for retirees or those looking for low-risk fixed income options. Then diversification. Treasury bonds can help balance out a portfolio that's heavy in riskier assets like stocks or corporate bonds. They provide a hedge during market downturns. And tax benefits. The interest from T-bonds is exempt from state and local taxes in US, which can be a nice bonus depending on where you live. Of course, no investment is without risk, even treasury bonds. So let's talk about a few things you need to keep in mind. First of all, interest rate risk. If interest rates rise, the price of existing bonds falls. This is because new bonds will be issued with higher rates, making older, lower interest rate bonds less attractive. If you need to sell your bonds before maturity, you would end up losing money. Inflation risk. Treasury bonds may not keep up with inflation. While you are getting fixed interest payments, rising prices can erode the purchasing power of those payments over time. An opportunity cost. Treasury bonds tend to offer lower returns than other types of investments, like stocks. If you are looking for higher growth, you may find bonds a little bit slow. So, how do you know if treasury bonds are right for you? Well, it depends on your financial goals. If you are nearing retirement and looking for something stable, treasury bonds can be a great option. They provide consistent income and reduce risk in your portfolio. On the other hand, if you are younger and focused on long-term growth, you might want to consider a more aggressive investment strategy. It all comes down to balance. Many financial experts recommend holding some percentage of bonds in a diversified portfolio, especially as you get closer to retirement age. If you are interested in buying some T-bonds, there are multiple ways how you can do it. First of all, directly from the US government. You can buy bonds directly through treasurydirect.gov. This is the most straightforward way and doesn't involve any fees or middlemen. Then throughout broker, you can also purchase T-bonds through your brokerage account. Some investors prefer this for the convenience of having all their investments in one place. And lastly, bond funds. If you don't want to buy individual bonds, you can invest in bond mutual funds or ETFs, which pull together various bonds, including treasuries, giving you instant diversification. Alright, that's all we have for today on treasury bonds. They may not be the most exciting investment, but they've been a cornerstone of government financing for over 200 years, and they still have a place in many portfolios today. If you enjoyed this episode, don't forget to subscribe, rate, and leave us a review. Let us know if you have any questions or topics that you'd like us to cover in future episodes.